Mr. President, on August the 28th of this year, the 6 federally regulators of the banking industry reported out on their charge to promulgate a rule required by Dodd-Frank known as the QRM rule, or the Qualified Residential Mortgage. The Qualified Residential Mortgage rule was a rule that Senator Landrieu, Senator Hagan, and I put into the Dodd-Frank legislation to provide for a parameter for residential mortgage loans to be exempted from the risk retention requirements of Dodd-Frank if they met a certain standard. And these regulators were charged with establishing that standard. That law passed over 5 years ago, and we're just now getting to the promulgation of the rule. But I'm happy to say that I rise today on the floor of the Senate to memorialize my support for a job well done. The Qualified Residential Mortgage Rule, which is being circulated now until October 28th, is the right answer for the requirement of Dodd-Frank and for the American housing industry. For the education of the Senate and the public at large, the Dodd-Frank law and desire to make sure that loans that were underwritten were better underwritten and loans that were made were better made loans so there'd be less default and less problems in the housing industry required the banking industry to make only qualified residential mortgages as defined. The original discussions by the banking industry was part of that definition would be a required 20% down payment, which I and many, many people in America strenuously objected to because a 20% requirement to exempt from risk retention would be far too great a down payment for most American families to meet, would have probably meant a decline in the housing market even greater than we experienced in 2008, 9, 10, and 11, and would have had a negative impact on America's economy, unemployment, and America's health and well-being. So the banking regulators did a great job in their rule, which does the following. First of all, it equates QRM, or the Qualified Residential Mortgage Rule, with the QM rule, the Qualified Mortgage Rule, which Richard Cordray, the director of the Consumer Finance Protection Bureau, promulgated about a year ago. Mr. Cordray did an outstanding job of seeking input from people in industry and the trades that are affected by the housing industry, and wrote a rule that made sense. That rule required the following. It required good, solid underwriting, a maximum ratio of total debts to total gross income of 43% so that you would not have somebody borrowing more than half of their take-home pay or their gross pay in order to service debts. That would mean people would have the money to pay their mortgages. Required people verify their income, verify their credit, verify their employment, and verify the value of the property that's being purchased with a loan. All those things are the standards that served America well for years until the subprime lending took place from 1999 through 2006. So I commend Richard Cordray and the Consumer Finance Protection Bureau for defining a qualified mortgage as one that is well underwritten. A required down payment is not necessary to have a qualified mortgage because underwriting was what led us into the difficulties of the past 5 years in the housing industry. We went through a recession that was not a down payment recession, but it was an underwriting recession. When Congress itself was partially to blame when it mandated that Freddie Mac and Fannie Mae hold a certain percentage of their portfolios in what was known as qualified residential mortgages for the purposes of meeting underserved people in society. Those underserved people in society ended up being credit risk or higher credit risk. They became known as subprime lenders. They got guaranteed by the government. They were sold in securities, and when they defaulted, the securities went down. The American housing industry went down. The American Federal Reserve had to bail out people like AIG, and we went through the worst housing crisis in the history of the United States of America. So by the proposal by the 6 banking regulators to merge QRM and QM, they are recognizing that underwriting is the key to sound loans. And by requiring good underwriting to exempt from the 5% risk retention required in Dodd-Frank, we're ensuring a robust housing market, robust and available capital through Freddie Mac, Fannie Mae, and through private institutions to ensure housing in America can return to the heights it's known in the past. And Mr. President, quite frankly, we're never going to get below 7% unemployment. We're never going to get higher than 2% growth in America and our economy until we return to a robust housing market. And we're not going to return to a robust housing market until we get liquidity in the credit markets for residential mortgages of a conventional nature. And that's only going to happen when Freddie Mac and Fannie Mae can make well underwritten loans, can secure well underwritten loans and guarantee them so they can be sold in the marketplace. The banking regulators who are now circulating the QRM rule for public comment did precisely the right thing to recognize underwriting was the problem, not down payment. Now lastly, in my comments, one of the things the regulators did put in their proposal for circulation for input was what if they did require a down payment of 30%? Would that be an exemption for the risk retention of under QRM. And I would implore the regulators not to consider doing that, because a 30% down payment would be even worse than 20%. It would restrict even more Americans from being able to be homeowners, and it would not address the problem. The problem was underwriting, the problem was not down payment. Credit enhancements such as private mortgage insurance and things of that nature can supplant a down payment requirement, but nothing can supplant quality underwriting. Richard Cordray wrote a good rule. The Consumer Finance Protection Bureau is enforcing that good rule, and I commend the bank regulators for merging the QRM rule with the QM definition to ensure that we return to a robust economy, a strong housing market. Don't revisit the problems of the past with shoddy underwriting, and instead look forward to a brighter future for the American housing market.